Hey investors, Kylie here, welcome to the channel. So I remember when I was a kid, I would always hear family members tell me that I should invest my money. Don't spend, invest.
Okay, but how?
And basically the answer was that I needed to get a stockbroker. So I looked into what my parents used at the time, it was Morgan's, and saw that the fees to buy stocks started from at least $70. So the cost to buy and sell a stock, $70 minimum. Since at the time I was making around $5 an hour in my after-school job, that wasn't exactly a feasible option. And also I had no idea if stocks were even the best way for me to invest my money. And anyway, which stocks would I choose? Okay, so today I'm gonna run through some of the ways you can invest your money into the stock market, especially if you only want to invest a small amount, say like $100. And I'm assuming basically zero knowledge here. So total beginners starting from scratch. Okay, so the first point is that you can buy stocks online. So in our parents' or grandparents' generation, to invest in the stock market, you needed to rely on full service stockbrokers, like the people you see in films about Wall Street. You know, you'd call up your broker and they'd be out playing golf and he'd give you some advice and you'd discuss what stocks to buy and sell and they'd make the trade and it would cost you a fortune. But unlike in the 80s, there are now a lot of online stock trading apps that you can use to buy and sell stocks directly online. And these are super cheap compared to before. So you are actually making those trades yourself. You're not calling up a broker and they're making it for you. And many of these let you invest $10 or less into individual stocks, and some have no minimal investment at all. And if you're worried that it's still hard, well, actually it's probably the opposite. Like, it's almost too easy. Here, let me show you how easy it is. So I'm just going to make a trade on my phone using the trading app eToro. So by the way, eToro is an online broker that is available in some countries. It's not available in the US, but there are other brokers similar to that in the US, like Robinhood. Okay, so I'm just gonna look up a really obvious company here, Apple. So here you'll have your buy and sell options. Usually with most online brokers, especially the lower cost brokers, you'll get 2 or 3 options to trade stocks. So you can either select the at market order, which buys the stock at the price that it currently is when the order goes through, or you can set a limit order, which means that you can set the price that you'd want to buy that stock at. So it's similar to like when you're trying to place bids on eBay. You'll have the price that you set, and then lots of other people will set their prices. If everybody else's price is a lot higher than your price, then you're probably not going to get it. And so I'm switching it to rate. eToro has called it rate. That just means it's a limit order. I want to buy it at $100 because I am feeling like it's going to crash. Set order, and my order will go through if Apple is purchased at $100. And it's always a good idea to set a limit order because the market can be really volatile. And if you set a market order, you just don't know what price you're going to end up purchasing that stock for. So you can see here that actually buying stocks is pretty easy. It's picking the right stocks to invest in that is much harder. So in general, here are a few tips that you can keep in mind when you're trying to pick your stocks. So tip number 1 would be to ignore social media. So in 2021, you probably noticed that meme stocks like GameStop, AMC, Nokia have become really popular. And if you haven't heard of any of those things, well, don't worry too much about them. As you do more research, you'll see lots of people talking about them on social channels like Reddit's Wall Street Bets. But the thing about these stocks is that they're incredibly speculative, meaning that they're basically really volatile. So you could easily lose a lot of money. Instead, your safer option is to start by investing in the major blue chip companies like Apple, Amazon, Coca-Cola, because these are less likely to be volatile and they're a safer bet over the long run. Okay, invest for the long term. So studies have shown that long-term investing, so buying a stock and holding it for a long time, pays off better in the long run than if you'd had actively traded that stock. Another thing to bear in mind is that you can lose money. So as much as people talk about how investing in the stock market makes sense, you can actually lose your money. You can lose your entire investment, and a lot of people have. It's just that when you look at a longer time frame, this risk is reduced. So this Vanguard chart of the S&P 500 is a great example. So you can see volatility over different periods, including the GFC, but in the long run, you can see that it still trends upwards. And that's the point of investing in the stock market. You are betting that the market will continue to go up, because the economy will continue to grow. You know, the stock market could crash at various points in time, and that is absolutely to be expected. Those stock market crashes are completely unpredictable for the most part. No one ever expects them. Some people say that they do, but you know, that's questionable. So the idea is that you ignore that volatility and just buy and hold, and you'll be good. Okay, next would be to invest in a diversified portfolio. So it's risky owning just a single company stock. As a general rule of thumb, you'll want to hold at least 10 to 20 stocks that aren't all from the same sector. This protects you from volatility, like if one stock crashes and never recovers, you know, others will support it. It kind of all balances out. Think about dollar cost averaging in. So if you're just starting out, you're bound to make, you know, a few mistakes. So don't go all in. Start by investing a small sum of, say, $50 or $100. So dollar cost averaging is where you slowly increase the amount that you've invested over time. So you're not all in one go. Okay, so those are the main tips to bear in mind when you're investing as a total beginner. So you'll often hear that investing in a diversified portfolio is key, and that's really true. But you know, it does take quite a lot of time and money to build up a portfolio with that many stocks in it, especially if you're paying brokerage fees, which is the cost per trade charged by your broker. It's worth mentioning that even if your broker says they charge zero brokerage, it just means that the cost is coming out somewhere else. So just a side note, you should check what that is. But you actually have an easier option, and one that is arguably better for new investors or for people that don't want to spend too much time working out what to invest in. Plus, have been proven to give arguably better results than if you'd picked out your own stocks, unless you're Warren Buffett. But even he invests in these. So I'm talking now about exchange-traded funds. So exchange-traded funds are just investment funds that hold multiple company stocks. So instead of buying stocks in a single company or one or two companies, you can buy stocks in hundreds of companies in the one go. The reason this is safer is because individual stocks can be really volatile. You know, you could buy stocks in a company and lose your money if the value of the stock goes down. As when you've got a really diversified portfolio in an ETF, if a few stocks are underperforming, dozens of other higher performing stocks will balance it out. So it's worth mentioning that you've got all types of ETFs today that do all kinds of crazy things. Like you've got meme stock ETFs that just track, you know, stocks that people are talking about. You've got oil ETFs that just track oil companies. You can kind of get any type of ETF these days, depending on what strategy you want to follow. But one of the safest options is to choose an ETF that holds stocks in major companies, and these are usually included in a stock market index. For example, the S&P 500 index, which is the 500 biggest companies in the United States. So you know, if you ever hear someone saying, just invest in the S&P 500, this is what they mean, an index fund. And one of the biggest supporters of this index fund strategy is Warren Buffett. And I actually did a video on him recently, so go and check that out, link in the description below. So ETFs trade on the stock exchange along with other stocks, which is weird to think about, but the main reason this is important to you is that you can access ETFs via online brokers, so the same brokers that you use to buy and sell stocks. If you're looking for an online broker, some of the more well-known ones are Robinhood, eToro, Interactive Brokers, E-Trade, Charles Schwab. It depends on what country you live in. And for more on how you can invest in ETFs, you can check out my other video. I've dropped the link below. So it's worth mentioning that some brokers have a minimum investment. Like for example, in Australia, there are only a few brokers that let you invest less than $500 into ETFs. So you might need to do a bit of digging. Another option is to invest with a robo-advisor. So this is another pretty easy option. Just invest through a robo-advisor or a micro-investment app. And two of the most well-known of these are Acorns and Goodmint. But again, it depends on where you live. Robo-advisors are usually mobile platforms, and they invest your funds into a portfolio of stocks or ETFs. The fund managers of these portfolios pick and choose stocks or ETFs based on their portfolio criteria, but usually these are relatively low risk and very diversified. The difference between these apps and, say, a regular hedge fund is that everything is done on your mobile or computer. The portfolios are super easy to understand, and sometimes you get a recommendation on which one to choose based on, you know, a questionnaire of some kind. And investing with the right robo-advisor can absolutely be a great way to grow your wealth over time. Full disclosure, I use a robo-advisor myself. It's one of the options I use to invest my money. So I use Raise, which is the equivalent in Australia of Acorns. It's basically the same robo-advisor, it's just different branding. Basically, it's a micro investment app. So every time I spend money, it rounds up my spare change, it adds it to my portfolio. I really like this, that's why I use it. I also invest some money into Spaceship, which is another micro investment app. Its portfolio has done really, really well over quite a few years now. I invest in stocks, ETFs, and cryptocurrencies, so I'm pretty diversified. And one more point that I want to mention, because I think it's really important, is that you can also choose to invest your money into a retirement fund. And the reason I suggest this is because there are often tax benefits to doing so. So absolutely you'll need to do a bit of research into what kind of options are available in your country. But for example, in Australia, we can add a certain amount of money from our salary directly into our retirement fund. We call them superannuation funds here, and we get a much lower tax rate on that salary. So we're not paying our regular tax rate if we choose to put it directly into our retirement fund. So doing that, and added to the tax benefits of that, it's a really great option. You should absolutely look into whether or not that's the right option for you. These retirement funds or pension funds, 401s for example in the US, usually they're a diversified portfolio of stocks, ETFs, bonds, property and cash. So really diversified and typically safe, but you'll absolutely need to do your research into which ones are available. Okay guys, that's it from me. Thanks so much for watching. If you liked this content, please hit the like and subscribe button. And if you want more like this, or if you've got any ideas for videos, feel free to leave a comment in the section below. Thanks a lot guys, see ya.